topic. So the very first thing that you need to know if you owe the IRS is that there are different things that you're going to be responsible for if you're a business owner that owes the IRS versus if you are somebody who is not a business owner. Businesses have a higher threshold, not higher threshold, but a higher, there's more at stake, right? Because if you're an individual and you owe, yes, there's a lot at stake, but when you're a business and you owe, you could actually lose your entire business. And so it's really crucial to make sure that you don't ignore anything that comes in from the IRS. Now, what can the IRS actually do to your business? This is one of the things that I get a question related to, like I owe the IRS. What does this mean? What is it that they can do? Um, a lot of owners don't realize they owe until it's too late. So until something comes through to say, hey, you owe, they don't know ahead of time. So the IRS can see how much you owe, obviously, because that's in their system, but they can also see how much money you have in your bank account. They can see how much money is in your business. They can actually shut down your cash flows entirely. So they can put a freeze on your bank accounts. They can levy things so they can pull money out of your bank accounts. I've actually talked to clients who ignored letters to the point that that actually happened. And this is not an exaggeration. I have seen it happen before, not with my clients, but there are clients who came to me after the fact. And that is why it's important to make sure that you're handling these things up front and not waiting until the end, right? Moving quickly is not something that's an option. You have to move quickly. So the moment that you know there is an issue, you're going to have to get started moving. So the next thing you need to understand is what you are actually dealing with. So just because you owe, you don't want to go into, let me go make a payment. Let me go do this. Let me go do that. What you actually want to do is find out why it is that you owe. Is the amount that you owe, is it valid? Is parts of the amount valid, but maybe other parts are not valid? You need to understand where the debt is coming from, why there is a debt, what you need to do to resolve the debt. All of those things are super important. So you should be looking at the documents that come into you from the IRS. You want to see what are the codes that are on those, because there are codes that are on those letters to tell you what the letter means. It will also describe what the letter means, where the debt is coming from. It'll break down interest. It'll break down penalties. So you need to take a moment to take a look at the letters to make sure that the information is actually valid. Maybe you don't actually owe that amount. Maybe you only owe a partial, a part of the total balance. Maybe you don't owe anything at all. So you don't want to just jump into crisis mode and just start paying, because now you're going to be paying a debt that maybe you don't owe. And I have found clients who have come to me again after the fact, who years ago there was a debt. They actually didn't owe it for one reason or another. They started paying on it, and guess what? The IRS won't give that money back because the time frame in which they will give refunds back, which is usually 3 years back, has already passed. So the money that they shouldn't have had to pay to begin with, well, not only did they pay it, but they're now not going to get it back. So you don't want to jump into paying it. That's not the solution. The solution is understanding the balance and what it is to see if you actually owe it, see if the balance is valid. And so this is how I would approach it if it was me. I would pull up that notice that I referenced. So when you get a notice from the IRS that tells you that you owe, I would look at that, look at the description, look at the codes. That code would tell you everything that you need to know, what the issue is, how urgent it is, when you need to respond. We use a code finder in our firm that breaks down exactly what the codes mean. And it also helps us to make sure that we're not guessing. So it will tell us how urgently we need to reply, if it's immediate, if we have 30-day time frame, that sort of thing. And then we also look at things like transcripts. So another thing you could do is pull up your transcripts. Go to your IRS account. If you've never gone to your IRS account, you have an IRS account, go to that account, pull up your transcripts, and you can actually see more in detail what those things might be. Now, you might not be able to read the transcripts, and you might need to get some assistance with understanding transcripts or reading transcripts. But The transcripts are going to help you see why you may have owed, what it stemmed from. It's going to give you some more additional details. Uh, I also look at what's called a transcript report, which summarizes all the transcripts. So if it's multiple years, it'll summarize it all into one transcript report and tell me what the balance is, what's owed from year to year, what the penalties are by year, what caused it in different situations. So it gives me all that information. You won't have a transcript report that you can utilize, but you can actually look at the individual transcripts. But definitely take a look at those and get an understanding of what these balances are, why it is that you owe, and how to resolve it. You can look at those transcripts that are going to help you. Again, you can get those from an IRS account. So if you've never gone into an IRS account, you can actually do a search on IRS personal accounts and you'll see it come up. And then either set up an account if you've never done it before, or you can actually go into the account if you have set it up before. It takes about 10-15 minutes to set up an account, but then you'll be able to go in and get your transcripts, see your balances, all of those types of things. So that's what I would highly suggest that you do. It'll also show you your balance by years, things like that, what it is that you owe. Now, if you're under audit, that's a whole different thing. I would definitely suggest you get help right away. Don't try to handle that on your own. You need to work with a professional. Um, the only thing that's going to come out of an audit without getting help is you're going to end up owing a whole lot that you actually didn't have to pay. So I highly recommend that you work with someone if you are in audit to get that help. So once you understand what your balances are, the next thing you need to do is you need to get into some sort of payment plan. So there are multiple payment plans. You can pay it in full, which is basically paying that full amount. I highly recommend this because here's the thing. I would rather you get a loan and pay the IRS off than for you to, and then you owe that bank, than for you to owe the IRS. And the reason why I would recommend that is the IRS can do things like freeze your bank account, freeze your cash flows, right? Freeze your passports. So you can't travel internationally. They can do a lot of things that a bank can't do, right? So I would recommend number one that you work with the bank in that regard. Also, IRS's debt compounds daily. So if you're looking at not paying that off right away, it's going to be compounding quickly. They have interest, they have penalty, they have things like that that are also compounding, that are being continually added. And so you're looking at a large amount. Now, at least if you are in with a bank, yes, they're going to also have interest that compounds, but you're not going to have penalty that also is compounded and being added every month as well. So because of all those things, I highly recommend you work with the bank. So again, the first option is you could pay in full. The second thing you could do is you can look at doing an installment agreement. So an installment agreement, they have different terms, short term, they have long term, they have all different types of installment agreements that you can do, collections, different things like that. So you can look at doing some sort of installment agreement with the IRS. The installment agreement is going to help you. So at least they cannot place a levy. So that means they can't go in, put a freeze on your bank account. They can't go in and take money out of your account unless you default or you're not making the payments consistently or something like that. Then they can. Otherwise, they're not going to place a lien, which is just allows them to be in place if you ever sell the asset, right? So if you have a house or something and you sell that house, they want to be in line to get their money. That's what a lien is. So for the lien, they're only going to put that in place if you're making monthly payments if you owe more than 50,000. So if you owe more than $50,000, they are going to place a lien no matter what. So a lien is going to come if you owe more than $50,000. You can get that amount under $50,000, and then work on the rest of the payment plan. So there's different things that you can do to avoid the lien, but it's definitely going to avoid the levy. So setting up an installment agreement would actually at least help you. Offering compromises or fresh start programs, so many of you have talked about that sort of thing, doing an offering compromise, doing a fresh start program. Well, here's the thing. A fresh start program or an offering compromise, whatever it is that you want to call it, Those sorts of programs, not everybody qualifies for them, right? So if you are somebody who is looking to do something like an offer and compromise, you have to see, first of all, if you can even be approved for it. Is it something that you can apply for yourself? Maybe. I find that even professionals like myself, when we're trying to apply for offer and compromises, many of us aren't even successful. So I would probably say someone who is not a professional, you're going to have an even more difficult time applying for an offer and compromise. And I think a lot of them will not go through. So I recommend that if you're trying to do an offer, you work with someone, you want to work with someone who's reputable. And I don't recommend large companies, because a lot of the large companies that you guys see online, many of them, what they do is they'll charge you an amount, $6,000, $10,000, $8,000, knowing right well from the information you're not going to get qualified for an offer. So how do you get qualified for an offer? There is the IRS looks at a uh, combination of things. They're looking at how much income you bring in, what your expenses are, but they're also looking at your assets. So if you have assets that have equity, so let's say you have a house and that house has $100,000 in equity and you only owe $50,000, well, you're probably not going to be able to get an offer. Not to say you can't, because they also can't make you sell your house, but a lot of times they will try and get you to refinance the house. I've sometimes seen people still get an offer even with their house, because what they don't want to do is put you out. So then you're having to get on something like state assistance, federal assistance, right? They don't want you to go onto welfare programs in order to pay them. So they want you to be able to pay them, but still be able to handle all of your other expenses. They're not going to just kick you out of your house. They, but what you're going to have to look at is what are your total assets and what you have in those assets in terms of equity, to see if whether or not you would couldn't get approved for an offer and compromise, right? Um, I highly recommend for something like that, you get some support. It's going to really be hard to do something like that on your own. And the last thing is currently not collectible. And basically, it's a financial hardship, right? So, what they're looking at is right now, um, temporarily, you're not able to make the balance. Now, I have seen some of, which means you don't have to make any payments at all. Uh, Basically, while you get on your feet, the clock, um, what we call the clock that determines when your debt expires, which is typically 10 years. There are some exceptions to that, because there are things that can extend that time frame, but basically 10 years. And if you are in the collectible status, not collectible status, and you're not making any payments, guess what? That debt can expire. I actually have some clients right now who are in not collectible status, can't be collected, and their debt is going to expire soon. So if you are somebody who is in not collectible status, that is great if that debt is going to expire. Because it can, in fact, yeah, it can, in fact, expire. So that's another great one, right? It doesn't erase the debt. The balance is still there, but it stops the IRS from coming after you. Again, if the amount's over $50,000, you're still going to see that lien. Business owners going through a rough period, though, this could be great because it could give you some of that breathing room that you need to keep your doors open, so you don't have to make any payments, but you can still make money, at least so that you can survive, right? Again, the IRS doesn't want to put you onto uh, federal programs where you're needing assistance. So that's an awesome option. The other thing you could do is to do nothing. Now, I highly don't recommend that you do nothing, because, again, with your business, the IRS will escalate. If they're not hearing from you, they're going to continue to escalate until they get what it is they're looking for. So they will send lien notices, they will send levy notices, they will start taking money out of your bank accounts. All of these things will happen. You could end up out of business because you won't have any assets, no income, and you won't be able to get any of them. So by the time it gets to the point that your options are so limited and more expensive to resolve this, you might have to shut down. So don't allow it to get to that point. So whether it is that you know how to handle this on your own, or not, understand that if you start dealing with it sooner than later, it's going to allow you to be able to get into a better position to work with the IRS. So again, you want to pull your notices, understand the codes, look at the deadlines, and then you want to move. You want to go into some sort of payment plan option, something that's going to help you get into compliance. And if you're not sure what you're looking at, or the situation seems bigger than you can actually handle, you can always schedule time with us, and we'll be happy to help you. We have a free consultation that you can take part in. Now, drop any comments below if you think, if you've been in this situation, if you are in this situation, what have you seen work for you? What has worked? What has not? And again, if you're ready and need some assistance now, be sure to reach out to us. We will be happy to help. Now, on to the next topic. Our next topic in this series of 6, in terms of what it is that you're going to do if you're owing the IRS, is what happens if you don't pay, right? So we talked a little bit about what you'll do if you don't pay. The IRS, that last one, right? But let's talk about this more in detail. So, what happens if I don't pay the IRS and I owe taxes? So, a lot of business owners are in a situation where they filed, but they did not pay, or they have been paying consistently, or they have been avoiding the mail, or they opened the mail and threw it to the side because it felt too overwhelming, whatever the case is. But let me tell you what happens when you actually owe the IRS, but then go silent. The IRS is an institution that can negotiate with people in the right circumstances, right? So they're looking to negotiate with you. But if they're not hearing from you, they are going to continue to escalate, right? Even if they're wrong. So sometimes I have people come to me and say, well, I don't really owe this. This isn't really my debt, different things. Well, here's the thing. You still have to address it. If you don't owe it, okay, great. But what do we need to do to address it so that the IRS will get off your back? Because if you don't address it, they're going to just continue to escalate. To them, you're just ignoring the notices. You can't do that. So again, the first thing you need to know is they're going to continue to escalate. So if you're not paying that balance, you're going to probably get a CP-14 first. This is usually the first notice. It comes out in the mail. It tells you what you owe and when it needs to be paid. Most people look at this, right? They put it back in the envelope, their stomach drops. I'm going to ignore it. Maybe the IRS will figure it out that I actually don't owe this. Maybe they'll just go away. None of those things are not going to happen. They're not going to go away. They're not going to ignore it. They're not going to fix it on their own. You're going to have to be instrumental in getting it fixed. That's the worst thing that you can do. So this notice is your earliest and your cheapest opportunity to resolve the situation. The balance at this point is what it is, right? It has some penalties, it has some interest. Maybe you can get some of the penalties removed. Sometimes you can even get interest removed, not often, but you can respond, you can get it handled. And honestly, even if you're working with someone like me, who's a professional in dealing with these types of matters, you can get this resolved relatively quickly. You can get it relatively quickly, right? The issue is if you don't do anything with it, well, guess what? The next thing, you're going to get your next notice. So you'll start getting notices in the 5, CP 501, CP 503, right? So when you get these notices, now we have some problems, right? So the first thing is, if you didn't respond to the CP-14, each notice after that starts to increase in urgency, right? Each one adds more language and what's coming. If you continue to ignore them, more penalties are being added, more interest. Literally more penalties, because when you get into an agreement with the IRS, the penalty amount drops versus if you're not. So it's 0.25% a month that gets added for unpaid balances. It's 0.5% if in compounding interest, in compounding penalties, if the balance is is not paid, but also you're not addressing it. So number one, it cuts the penalties in half. So if you're not addressing it, you're not getting to some sort of payment plan, that penalty amount is higher, the interest, all that is compounding. So you want to get it done as quickly as possible. A $10,000 balance can easily become a $20,000 balance like this, right? Because every month it's growing. So I've seen clients double their balances in about 5 years. It could be doubled depending on what the penalties are. It could be faster. So you want to make sure that you are addressing it. So you'll start getting those CP 501, CP 503s. Now it's getting a little more serious because guess what? That means they're about to levy you. All right. So they're giving you notice. They're putting you on notice, like, hey, you haven't responded. And so now we are going to look at levying you. And that's the next step. So the next thing you're going to get is CP 504, or you're going to start getting a letter. That CP 504, that letter, they're telling you, hey, we are steps away, right, from levying you. These are very serious. The IRS is telling you they're about to levy your asset. They're about to go into your bank account, take cash, right? And you still have rights at this point, but you don't have a lot, right? Um, you don't have a lot of options. So you need to address it. You can also request a collection due process hearing, which passes collection action, right? But you have a very short window, right? You have a very short window to start addressing this. You have to do something. If you don't do anything at this point, they are going to levy you. Okay. And that is the very next step. So after these letters, if you ignore them, they are going to levy you. So now if they levy you, that means they went into your bank account, froze your bank account, they pulled out the cash. And guess what? It's not a lot you can do. I've had people come to me after the fact say, hey, I was levied. I don't know what to do. Can you help me? Yes, I can help you in the levy. But the thing that you have to realize is that if someone like me is helping you in the levy, and sorry if I'm looking down, I'm just looking at my notes. But if someone is helping you after a levy has already taken place, a lot of times you're not getting that money back. So unless you can show them that they were wrong in the first place and they give you that money back, you're not getting those funds back. So that just means they took your money, that money is gone. Um, it's gone. Like there's not a hey, we can come back, we can save you. Nah, that money is gone. Um, And even if you find, okay, I'm going to now get into something, okay, great. Now you've gotten into a situation. Now you've gotten into a program where you're making monthly payments, whatever the case is. Fine, that's great. But the money they took is already gone. It's going to be applied to your balance. But a lot of people have a very hard time getting that money back. Most of the time, you're not getting that money back, right? Most of the time, you are not getting that money back. So you don't want it to get to that point, because you just ignored the notices. You got to address the notices. The other thing is liens. Liens will also happen if you, again, your balance is over 50,000, even if you're in a position where the IRS is actually, you're already in an agreement with the IRS, you are still going to be in a situation where they're going to place a lien if you owe more than $50,000. Um, Liens can affect your credit. It's a public record, right? So they can put it against your property. And what they're really trying to do is they're trying to put themselves in a position that if you sell, they get paid before you get any equity. So you want to get in line to get their funds so that you can't just sell the property and now they don't get their piece of the pie. And here's something that most business owners do not know. A lien can be filed before a levy. They can exist at the same time. And the lien, again, helps to secure that the IRS interest in the asset so that they're going to get their piece if you sell. So you want to make sure that you're addressing this situation, so that you aren't in a position where They're placing a lien or levy against you and your business assets. I mean, can you imagine if you do some sort of construction work and they place and you have a piece of equipment and they place a lien against it, so you can't sell that piece of equipment to get the money to even pay them or to do whatever else. Or they place a levy and so you can't even pay your payroll. I mean, how many people are going to come into work if you can't pay them? That's going to be a really big deal. So you want to make sure that you're addressing these things and you're doing so quickly. So, bottom line, you want to make sure that every step in the process you avoid it whenever you can, right? The IRS sends notices before they act. They give you warnings before they escalate. The problem is not that the IRS moves without warning. The problem is that a lot of times business owners wait too long. They keep thinking it'll get resolved. They keep thinking that something will happen. But at the end of the day, you got to make sure that you address your situations and you do so quickly. If you're somewhere on this timeline and you are needing assistance in this, if you owe the IRS and you're like, I'm not sure what to do, I don't know how to handle this, you'll be able to find, again, our how you can work with us. Write down in the comments. We'll be happy to assist you and help you get this resolved. And we can help you get this off of your hands. All right. So now that we've talked about that, the next thing we want to talk about is, what if the IRS did file a lien? So we a few months ago we talked about they can file a lien. Well, what if they actually did file a lien? So let's talk about that. All right. So if the IRS can file a lien, then if they already did file a lien against you, again, the purpose of a lien is to give them the ability to collect on assets, right? It puts them in line so that if you sell that asset, they can pull those funds, right? So if the lien is already filed and you found out when you tried to refinance, or your bank tells you or anything like that, you pull the credit, you see it. The first thing you got to know is a lien is not a levy. And a lot of times people think they're the same thing. So let me quickly outline what a lien is versus a levy. So a lien is a legal claim. It gives the IRS the ability, they're not taking anything, but what they have done is they put the world on notice that they are first in line on your assets, which is very serious, right? But it's workable. Like, you can work around it. It gets set when you owe more than $50,000, even if you are in compliance. So if you're in compliance, they will still place those liens to let everybody know that you owe more than $50,000. A levy, on the other hand, says, I want to go into your bank account and I want to take money. That gives them the ability to take things, right? You can go into your bank account and can take money. They can force a sale sometimes. They call it a quick sale. So they can get certain assets. So there are those are two distinct things, and a lien is what we're going to talk about here. So in compliance, you want to keep making payments. And again, even if that amount is over $50,000, they will still place a lien. So what does a lien actually cover? It can cover business property, personal property, financial assets, future assets you acquire. Any of those things can be covered in a lien. And the first thing that you have to do is get a full picture of what years are covered, what the balance is, what the assets are that are affected. One of the things we do is we pull your transcripts, we get a complete account history, so we are not making decisions based on incomplete information, right? We want to make sure that we know what's going on in your situation, how to address this situation. So back to what we're looking at. All right. Then the second thing we want to do is what we call know your options. We want to make sure, what are your options? Right? What are the options, right? The cleanest thing to do, obviously, is pay in full. A lot of people can't pay in full, right? And another video where we highlight what the different options are. Installment agreements offers and compromise, so on and so forth. You can find that video linked below. It talks about what your different options are and what that looks like, right? But you can pay in full. You can also look at doing a request for a lien withdrawal. So this is different from a release, and most people do not know that it exists. So a withdrawal removes the public notice of the lien entirely, as if it didn't happen. Now, you can request this under specific circumstances, including when you set up a direct debit installment agreement and are in compliance. And are in compliance is key, because if you're not in compliance, you're not going to be able to do a withdrawal. You're not going to be able to remove the lien. You're not going to be able to do any of those things. So the first thing is you got to get into compliance. If there's returns that need to be filed, you need to file them. If there is balances that need to be paid, you need to pay them or get into an installment agreement. You got to make sure those things are in place. If it's over $50,000, again, that lien's still going to be in place, but you might be able to do a lien withdrawal. And this is one of the strategies we look at immediately, because it has significant impact on your ability to get financing and business without the lien following you around. So this is crucial. All right. The third thing that you can look at if you have a lien already placed on you. So the third thing that we can look at is what we call subordination, which allows another creditor to move ahead of the IRS in priority. The IRS does not give up their claim, but they take a step back in line. So this is useful if you need to refinance a property or secure a loan to generate the funds so that you can actually pay the IRS. And sometimes they will go for this. So it's not that, it is an option. It's something you can look at, right? We want to find different ways that we can handle the lien if it's already in place. If it's over 50,000, I already told you the lien's going to be in place. But these are things that you can do if it's in place so that you can work around it, work with them to get this resolved. We've used this strategy to help business owners access capital so that they can actually resolve the balance with the IRS. The IRS, again, is flexible if you are flexible with them. If they feel like you're working with them, they will be flexible. If they don't feel like you're working with them, they will not be flexible. So the more that we can do to help them see like, hey, we're trying to also get this resolved, they'll work with us. They'll help us get these things in place, right? And subordination is another way that things can get into place if, in fact, you owe the IRS. So that's the third thing that you can do if you have a lien in place. Again, it's not going to get rid of the lien, but it will allow you to be able to possibly get capital so that you can help start to address the lien. The next thing is step 4, discharge, right? So discharge is what it sounds like. It removes the lien from a specific piece of property. Maybe not from everything, just from that one asset that we are requesting. And this can be useful when you need to sell a property or a business asset and use those proceeds to pay down the balance. So the IRS will agree to let the asset move free and clear in the understanding that the share of the proceeds comes to them at closing. Now, just because I've worked with so many people through the years, some people think, well, maybe I can kind of get away with it and not pay the IRS. That's not really something you want to do. If they allow you to discharge so that you can pay them part of the balance, right? Which number one is not easy to get anyway. But if you, let's say that we are successful, we're able to do that. Last thing you want to do is try and gyp the IRS, because they're going to get theirs one way or another. So don't put yourself in that position. Don't even think that's an option, because it's not. But you can discharge it so that you can pay them part of it. You might say, hey, I can't use that fund to pay all of it, but all of the balance, but I can use those funds to pay part of the balance, right? So you're trying to work with the IRS. Great. But just understand that you need to make sure that when you go to settlement, or go to closing, you're making sure that the IRS is getting paid their balance, right? So you have to know that going up front. Next thing is collection due process hearing. Now, I mentioned this In another one of our videos, if you receive a final notice from the IRS for a levy, this pauses all collections um, action while your case is being reviewed. So during this hearing, you can propose any of the resolution options, payments, offers, not collectible, but this is one of the most powerful tools available to business owners, and it's completely overlooked by a lot of people. So a collection due process hearing is something that you can have to try and figure out, hey, this is what I want to be able to do. This is what I can do. This is what it looks like. This is what I would like to try and address, or how I would like to try and address it. You can have that discussion with them. I often find that if clients come to me early enough, we don't have to go through that collection due process hearing. We can actually deal with a lot of these things far before it gets here. And it never has to get to this point if we are addressing it. We often end up here when we're not addressing it. We're waiting and we're waiting and we're waiting. So um, a lien, yes, does feel like the end, but it's not. It requires strategy. It requires you to move quickly. It requires you to think about what your options are and put something in place, right? I just walked you through multiple things that you can do in order to address some of these. And this is exactly the kind of situation where working with someone who knows the option makes a big difference in your outcome. So if you have a lien filed against your business, then you can go to the link again that's in the comments, and we'll be happy to assist you to help you get this resolved. Um, don't let a lien turn into a levy. Don't let it get worse. Don't sit on it another day, because the longer you sit on it, the harder it is to resolve these issues. So make sure you click on the link below so that we can get started. Now, next topic, payroll taxes. Now, payroll taxes are a whole different beast. If you are somebody who owes payroll taxes, this is one of the biggest and most challenging tax situations to be in. It's one of the most serious that a business owner can be in. I'm not saying any of this to scare you, but I'm saying it because the stakes are different here, and most business owners do not find out how different until it is too late. So when you have employees and you withhold taxes from their paychecks, that money is not yours, it's theirs. The moment you take it out of their paycheck, it belongs to the government. And the IRS calls it what they call it is trust fund. So these are trust fund monies, there's trust fund reserves, right? It needs to be applied in a certain way. This is money that goes towards that employee's retirement, Medicare in the future, all of those things. So it's very, very important, right? It is being held in a trust by you until deposit with the IRS, right? If you use that money for anything else, even to keep your business running, even to make payroll for the next period, even to keep the lights on, the IRS treat it as one of the most serious violations, not only the IRS, but your state. So not only does the IRS look at this as a huge violation, your state looks at it as a huge violation. Penalties are crazy when it comes to this, and so is interest. Interest is going to be interest, but penalties are crazy when it comes to trust fund recovery. So let's talk about the trust fund recovery penalty. All right. The trust fund recovery penalty um, is a penalty that is also known as TFRP. So if you see that, that's what it stands for, Trust Fund Recovery Penalty. The IRS could come after you personally for the employee portion, right? And not just your business. They can come after you personally. So I have even had a case where a client owed and they came after them personally. Those civil, they filed civil penalties against that person, which exceeded $150,000. Now, gratefully, in that case, we were able to show that they actually were not the responsible party, and we had all of it completely removed. We had the lien removed as well, and so they were absolved of any issues on the personal side. But I say all of that to say you don't want to mess around with these, right? Because they will come after you in the business, but also you personally. It does not matter what type of entity structure you have set up, a C corp, a S corp, a partner. They don't care. They will come after you personally if they feel that they can hold you liable. And there are certain rules, there are certain laws to help them determine who could potentially be liable. So even if your business is structured, they will come after you. They can and they will. So they look at who is the signing authority, they look at who made financial decisions, and that's where they choose to hold liable. So that means your personal bank account, your personal assets, your credit, all of those things can be affected. And I have seen this happen to individuals because of these payroll funds. Payroll, again, is not something you want to mess around with. So what would I do? If I was in this situation or if I have a client in this situation, what would I do? So the first thing that I would do, um, the first thing that I would do is make sure their current payroll, so not this payroll that's being affected, but the current payroll, make sure that payroll is being made on time. Even if they cannot pay the back balance, stay current on what is happening right now. So the IRS looks at this. If you are behind on the past, but staying current on the present, it tells them at least you're trying to resolve it. I also use that as part of the argument to say, we are in the process of trying to resolve it. We realize that this is an issue. They've hired me for assistance. They've hired a bookkeeper. They've hired a tax preparer. They've hired whatever they hired for the client. I show a pattern of trying to get compliant and to not only get compliant, but to ensure that this doesn't happen again. If you're falling further behind and you haven't addressed the current debt, that's also not going to look well on you. So you got to be able to stop that bleeding. You got to be able to put something in place so that this doesn't continue to happen. That's going to be very, very important. The next thing is you need to assess the full exposure, right? So again, we got to pull the transcripts, find out where it came from. Why wasn't it submitted? Sometimes it's a situation where it could be submitted to the wrong account. Okay, well, that's an easy fix, right? We got to get it put into the right account. I wouldn't say easy fix, but it is a fix that can happen, right? The money is there somewhere, but it was put in the wrong place. So now we just got to show where it went, show that it's all gone there, and therefore get it transitioned to the right place. You got to see who the IRS holds responsible, who was responsible for that. You need to understand that within your firm if it's not you. So you want to just understand the full exposure of what's going on, what's owed, how much is penalty, how much is interest. Penalties, like I said, are crazy. So a big part of what you owe could just be penalties and not the actual trust fund itself. People will also often ask me, if that's the case, can we just pay what's owed and not the penalties and interest? And the answer is no. It doesn't work that easily. You have to they want you to address it in totality. If there's a reason that we can actually remove penalties, yes, we can look at filing forms to remove the penalty. But it's not a situation where you can just go in and just be like, well, we're going to just remove penalties and just play the funds. That's not how it works. The next thing you want to do is you want to look at um, addressing the actual outstanding balance itself. So if the IRS has not assessed a penalty already personally, then we got a little work, we got a little room to work in. So you want to go ahead of the assessment, because once it's assessed personally, the resolution path becomes significantly more complicated, but it also becomes more expensive. So if it has already been assessed, we look at options, penalty abatement, installment agreements, all those types of things. If it hasn't been, then let's try and get something in place to make sure we can get this resolved. In some cases, you can do an offer. These are some of the most difficult offers to come by. It's very hard to absolve this debt and not pay it because, again, this is someone's Social Security, their Medicare. These are things that they need for that employee. that employee didn't receive. So it's very, very hard to get something like an offer in these. Um, Not impossible, but very difficult. Okay. So I always tell people don't anticipate that that's something that we can do, because a lot of people, a lot of times that's not, it's not a viable option, right? We got to look at what the options are, and that may not be one. The next thing you want to do is negotiate with the IRS from a position of information. So the IRS will conduct an interview to determine who is responsible. This is not a conversation you want to walk into without representation. I say it again, do not try to handle these types of situations on your own. These are ones where you need representation. When you're talking about a trust fund recovery, more than likely you will not be successful if you're trying to do this on your own. I'm not going to say 100%. Maybe you can be successful, but most of the time you will not. So what you say in the interview, it matters. I always say everything you say can and will be used against you. Um, just like regular other situations, lawful situations. So it really matters. Having someone in your corner that understands how the IRS does this, how they work their investigations, all those things, super, super important, right? It's not optional. You want to make sure that you're working with someone who knows what they are doing. I actually had someone who went into the IRS. When they talked to them, they told them one thing. When they came to me and they explained it and I asked additional questions, clarifying questions, they told me something different. It wasn't that they were trying to lie to the IRS. It's just they didn't really understand what they were doing in terms of bookkeeping. And so when they did certain things, they got money from people to help them keep their business afloat, and they put that money in the business. Well, they told the IRS that was money they made. Well, that's how what they said was interpreted by the IRS. I don't know what the exact question was answered because I was not there. What I do know is it looked as if the money had come in was actually for the purposes of um, running the business, and it could not clearly show, and they couldn't show a clear path of like the money came in and then the money went to the business, so therefore it's not really business money. The way it was all done, the books were very messy, it was not clear, and so they ended up having to pay a significant amount of money, taxes on money that was actually given to them. It should have been a business and investment. It should not have been considered money earned or revenue, because it wasn't. But because they had gone in and said that, and didn't fully understand the questions from the IRS, and they made certain comments, well, guess what? Now the IRS held them to what they originally stated, even though we found out later that their understanding, their interpretation of certain things was like, oh, that shouldn't have been this in the first place. It was already too late because they had already explained it to the IRS in a way that was incorrect. So you want to make sure that you are clear on the things that you're saying, and you are bringing clarity so that you don't want to end up in a bad situation. So get representation. This is not an area where you want to try to do this alone. Again, if you are somebody who's behind on payroll taxes, this is a very urgent matter. You want to make sure that you get this handled right away. Above everything else we have discussed, this is one that requires immediate action. So don't wait. Don't try to handle it on your own. Don't assume it'll work itself out, because it won't. If you need any assistance here, we'll have a link in the comments so that you can schedule a call. All right, moving on to topic number 5, which is um sorry, again, I'm taking notes. But moving on to topic number 5. The penalties business owners do not know are stacking up. So, let me show you something that changes how most business owners look at their IRS situation. It's not just about what you owe, it's about what is being added to what you owe. The IRS has multiple penalties that apply simultaneously, all at the same time, all for the same debt. Um, you don't just pick one, they layer them up, add interest, and it compounds. And so that's why I say it only takes so many years before your debt is fully at um, double of what you originally owed. And a lot of people say that, hey, that's not fair. That's the IRS. That's the way it works. So, so let's talk about the first one, failure to file penalty, right? Failure to file penalty. Failure to file penalty is 5% of your unpaid balance for every month or partial month that your return is late, up to 25%. So if you have a balance today that has not been paid, it will take 5 months to have a 25% penalty on that balance that you're going to have to pay, right? So let me put it in real numbers. If you owe $20,000 and you did not file on time, the failure to file penalty alone will be $5,000 on top of that 20. It only takes 5 months to get there. This is why I say file even if you cannot pay, because the failure to file penalty is 10 times larger than the failure to pay penalty. Filing without paying is always better than not filing at all. I'm going to say that again. Filing without paying is always better than not filing at all. The next one we're going to talk about is the failure to pay penalty. So there's a failure to file. The next one is failure to pay. The failure to pay is a penalty that is 0.5%. Okay, half of a percent per month on unpaid taxes. This one runs quietly in the background. It feels small until you realize it's been 18 months. And if you have both the failure to file and failure to pay at the same time, the combined rate can reach 5% a month. Very, very fast. Actually, that will be 5.5% because the other one is 5% already, right? So it's 0.5%. It does max out also at 25%. But if it's 0.5%, that's 50 months? Some people who come to me have balances that are 5, 6 years old. So now you have 25% on the failure to file, and now you have 25% on the failure to pay. That's per balance, right? So that's per year. So you can have one for this year, you can have one for the prior year as well, all running together. You got 5 years in a row, 0.5, 0.5, 0.5, 0.5, right? You have multiple years in a row. Well, guess what? Now that's 2.5 total. And so you have to really be aware of that failure to file penalty, because that also adds up. Again, keep this in mind that it's on every balance for every year, including the interest as well. All right. So the next one is your estimated tax penalty. So this one catches business owners off guard. If you did not make your quarterly tax payments or they're unpaid, the IRS charges a penalty on that shortfall. This is one of the most common surprises I see. They thought they were current because they filed by April. They did not realize the IRS expected payments in April, June, July. I'm sorry, September, January. Missing those quarterly deposits creates a penalty that is completely separate. Also, states normally, certain states, not all states, but certain states also have their own estimated tax penalty that you're paying there as well. And if you're in a situation where you're in an installment agreement for something, they are expecting estimated tax penalties. They're expecting returns to be filed on time. All of those things could actually cause your entire compliance, whatever you use to whatever you went into with the IRS, to be thrown out. So it's really important to make sure that you have clarity around that as well. The next one is your trust fund penalty. Now, we talked about trust fund penalty in earlier, but we covered this in our payroll section. 100% of the unpaid employee portion of the payroll taxes against the responsible party will be in that fund. This is not a percentage. This is a monthly addition. This is a full dollar for dollar assessment against you personally. It's the hardest penalty in the IRS structure. 100% of the unpaid employee portion of payroll taxes assessed personally against against the responsible party. Again, you don't want to mess around with those. So those are just some of the penalties that you should be looking at for if you're a business owner. The IRS doesn't pay around. Remember, I said these are compounding, they get added on top, they get stacked. And so you want to make sure that you're getting these taken care of. So let's do an example, right? Because we went through so many penalties. Let's go through an example. So a business owner owes $30,000. They have been ignoring it for 18 months. By the time they sit down, their new balance is $42,000. There was 12 extra $1,000 entirely penalties and interest. It did not come from a new tax liability. It came from waiting. $12,000 that could have been avoided, that could have gone to something else, that could have helped with payroll, that could have helped with anything else in the business, is now going to the IRS. So the cost of not addressing these things, the cost of not doing these, because those penalties add up quick, the cost of that, y'all, it's just not worth it. Address the penalties, okay? So what penalty abatement means. So let's talk about penalty abatement. Here is something most business owners do not know, right? Um, when you have penalties, there are certain ways that you can get the IRS to remove those penalties or reduce the penalties. It's called penalty abatement. There's a first time penalty abatement that's available as long as you have a clean compliance history. They usually will look at whatever the oldest year in the sum of years and what the penalties were for that year. And that's usually what gets abated if you have multiple years. But they'll look at abating the penalties as long as you haven't had anything in the last 3 years. If this is a significant IRS problem, you may qualify to have a significant portion of the penalties removed. Then there's reasonable cause, which applies when you demonstrate that there is a failure to file or pay was due to a circumstance beyond your control. It could be a natural disaster, a death in the family, it could be a fire. There's different things that will fall under there, but a reasonable cause can also help remove penalties if you cannot get the first time penalty abatement. And the penalty abatement does not apply to everyone, but it is always something we evaluate when we take on new cases. Because if we can reduce any of the balance, we want to do that first before making payments towards the balance. All right. So in conclusion, penalties are real, interest is real. They don't stop just because we wanted to stop or we ignore the letters. Every day that passes, those things are growing. So if you have an IRS balance and you're not sure what penalties have been applied or whether you qualify, that's something that we can look at in our first conversation. You can book a call by clicking on the link below and getting the help that you need to get you out of this mess. All right. The last topic we're going to be talking about today is I filed my taxes. I forgot a form. What do I do? So I get this question a lot. Like, oh man, I filed my taxes. What do I do? This one is very fixable. If you filed a return, everything felt like it was done, you checked it off the list, and then 2 weeks later, you get a 1099 in the mail, or your accountant calls and says, hey, we missed something, or you're reviewing your records and you realize one of the forms wasn't in there. What is it that you do? The very first thing you need to do is don't file another return. Don't panic. I should say the second thing you should do is don't file another return. The first thing, don't panic. Second thing, don't file another return, because that's not how it works. All right. We're going to talk about what it looks like if you forgot to file a form, what you need to do, and what steps you need to take. All right. So the very first thing is determine what was missed. And the reason why this is important is because you don't want to go and address what was missed, and then there's other things that were missed. So you need to take a total picture, make sure you have all the information for anything that might have been missed. Okay. The second thing is it something that created a tax liability? Did it increase what you owe? Does it get you a refund? Does it affect the part of return of that return? Understanding the actual impact tells you whether or not it's urgent, whether or not an amended return needs to be filed. So for instance, you could have forgot your 1095 form, which is basically your health form, to say, hey, I had insurance. Some states still require this form. And so They want to know that you received the form, but they're not asking for a copy of the form. The IRS doesn't ask for a copy of the form. They're not asking you to put any information on the return about the form. If that's the case, then guess what? You don't have to worry about filing an amended return. You just say, hey, I got the form. Great. Now I'll put it to the side. If it is a form that's going to impact the balance, amount you owe, refund, any of that, then you might need to do an amended return. All right, so that's the next thing that we're going to talk about. Now we're looking at an amended return. So if you have an amended return that needs to be filed, the way you correct that is to actually file an amended return. It's a 1040X for businesses. If it's Schedule C, that's what it is. And we're just looking at Schedule C's right now. But here's what you need to know about the amendments. You have 3 years from the original date to file an amended return and claim a refund. So if you're looking at getting a refund, you only got 3 years to do that from the original date. The longer you wait, the more penalties, interest accrue if there's a balance due. Amended returns currently take the IRS several months to process. In fact, I had one recently, took 2 years, a little over 2 years. It's taken an incredible amount of time for them to file. So don't expect a quick turnaround, but you're going to file an amended return. And if you don't know how to do that, hire somebody to do it. Don't try to do it on your own. All right. The next is understand that the IRS already knows. Now, I get a lot of people say, how I'm just not going to include it. It's 1099. Well, here's the thing. The IRS does already know, and they're basically trying to see if you include it. They may not come this year. They may not come next year. They may not come for a few years, but they usually do come, especially in the case of 1099 income, because they receive a copy of the 1099 that you received. So if it's not on your return, they'll eventually find it. You're going to owe that balance, and plus penalty and interest. So filing the amendment now is the thing that you need to do. I know sometimes it feels like, I'll wait. Don't recommend it. You need to go ahead and file now. The next things, again, if you are under audit, and I've talked about this in other videos, also earlier in this video. If you are under audit, it changes a lot. One of the things is you definitely need to get representation. But if you see something was missed and the process, that process is going to be very different. You can't just file an amendment. You need to work with a representative to address it within the audit process. This is a situation this is not a situation that you should navigate alone. If you're in an audit, something new has come up, you need to address it, okay? And do so immediately. They have to handle a totally different process if it was in audit. You might want to reopen the audit so you can get it addressed, especially if it's something that's going to make significant impact. So make sure you take the time to sit with someone, go over that before you do anything, right? The biggest thing is you want to just be proactive, right? And how you're doing things. This also might be a sign for you to check what's going on, what is going on with your bookkeeping and things like that. Maybe you need to make some adjustments, right? To how you're doing things so that you don't continue to have this problem going forward, right? Maybe you need to make sure your bookkeeper, does your bookkeeper have a system to flag things? Do you have a system to flag things, like if things are being missed? If not, you might need to make some adjustments. These are not complicated systems, but they help to prevent stressful situations from repeating themselves. So at the end of the day, a forgotten form isn't a crisis, but you also don't want to ignore it, okay? So you want to make sure that you are addressing it. You want to make sure that you are addressing it. You want to file the amendment. You want to do it quickly. If the situation is more complicated than a simple correction, multiple years involved, if you're under audit, any of those things creates a balance. You can't just pay it. You might need additional support. You might need to do an amendment. Again, if you're under audit, can't just do an amendment. So you want to make sure that you are getting the right guidance so that when you address it, you're addressing it one time, not multiple times, not spending a ton of money doing this over and over again because you messed up the first time and now you got to file another amendment. We can handle those internally here. We can walk you through the process, help you understand the impact, whether or not this needs to be done. The link is in our description if you are needing any support. So thank you so much for watching today's video. We covered a lot. And before we go, I just want to kind of bring it all together. So some of the things that we talked about today: what are your options as a business owner if you owe a balance? What would you do step by step? We also talked about what the IRS does when you go silent, right? They start sending lien notices, levy notices, so you know where you stand in the process. We covered what to do when you get a lien filed against your business and the options most people do not even know exist to help them with those. We talked about payroll taxes. We broke down the penalties that are stacking up every single month when you wait and how penalty abatement can actually reduce your balance. We talked through what to do. We talked through what to do. That's my dog. I don't want her to start barking. We talked through what to do if you are in a situation where you owe payroll taxes. We broke down penalties that are stacking up every month. We talked through what to do when you forgot a form. Here's one thing you need to take away from everything that we covered today. The IRS is not going away. That's the biggest thing I want you to know, right? Neither are your options. The earlier you move, the more options you have, and the less this costs in money and stress and impact in your business. Every situation we discussed today is something that we handle regularly. Business owners come to us at every stage, from that first notice to levies, and we build path forwards for them. We clean them up, we get them into compliance, and then we get them in ongoing support so that they don't end up here again. If you click the link in the description and book a strategy call with us, we will look at your specific situation, pull your information, and tell you exactly where you stand. That link is in the description right now. And before you go, drop a comment. Let me know that you were here today. Thank you so much for watching, and I will see you in our next lesson.